Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the crazy world of corporate finance, and believe me when I say this report has some things we need to untangle. Today we're diving deep into Odysight.ai Inc's latest quarterly report. We're talking about revenue, expenses, and what is really going on behind the numbers. Stick around, you won't want to miss this. And hey, if you want more of this kind of straight talk about company filings and business strategy, make sure you are subscribed. We've also got a fantastic community Discord channel linked down in the description below, so come join the conversation. So Odysight.ai Inc. is a company that has been working on vision-based platform solutions. Think of it as using fancy cameras and artificial intelligence to help other companies keep track of important equipment, especially in tricky places where humans can't easily reach or see. They serve markets like predictive maintenance and condition-based monitoring, which basically means helping prevent equipment from breaking down unexpectedly. They even had some early success with NASA and have clients in the aviation and medical sectors. Now let's get to the heart of it, the financial tables. Looking at their balance sheets as of the 30th of September 2025 and comparing it to the 31st of December 2024, we see some interesting shifts. For instance, their cash and cash equivalents shot up from about $18 million to almost $30 million. That is a big jump in cash, which is generally a good sign. However, they also have a new item here called restricted cash, which is now $331,000 and was zero before. This means some of their money is tied up and they can't just spend it freely. On the liability side, their short-term contract liabilities went down from about $702,000 to $240,000. This could indicate they have fulfilled some of their obligations or perhaps received fewer advance payments. Now let's look at the shareholders' equity. Their additional paid-in capital jumped significantly from $64.2 million at the end of 2024 to over $87.8 million by September 2025. This big increase almost certainly points to successful fundraising efforts, which we'll see more about later. Moving on to the income statement, the statement of operations and comprehensive loss for the 9 months ending the 30th of September 2025 shows revenues of about $2.6 million. This is slightly down from $2.7 million in the same period last year. Their cost of revenues also decreased slightly from $1.96 million to $1.88 million. This means they spent a bit less to generate that revenue. As a result, their gross profit remained pretty much flat at around $695,000 for both periods. This suggests they had a stable ability to cover the direct costs of their products or services. But here is where things get interesting. Their research and development expenses surged from $4.7 million in 9 months of 2024 to a hefty $7.3 million in the same period of 2025. That is a 56% increase. They mention this is due to developing new products, hiring more people, and working on Industry 4.0 projects. This is a big investment in the future, but it also means they are spending a lot more money. Sales and marketing also saw a big jump, nearly doubling from $806,000 last year to $1.6 million this year. They link this to expanding their sales efforts and increasing product visibility, which makes sense as they push those new products. All these increased expenses, especially in R&D and sales, led to a significantly larger operating loss. For the 9 months ending the 30th of September 2025, their operating loss was $13.7 million, up from $8.7 million in the previous year. That's a 57% increase in their operating loss. It's clear they are prioritizing growth and future development over immediate profitability. This larger operating loss directly translates to a bigger net loss. Their net loss per S-hair went from a negative $0.74 to a negative $0.81 for the 9-month periods. They are losing more money on a per-share basis as they invest heavily. Now let's look at how all this change is reflected in their equity. The statement of changes in shareholders' equity shows the impact of their fundraising. For the 9 months ending the 30th of September 2025, we see a significant issuance of shares. They had an issuance of shares net of issuance costs that brought in over $20.8 million. This comes from their public offering in February 2025, where they raised gross proceeds of about $23.7 million. This influx of cash is what explains that huge jump in additional paid-in capital we saw earlier, and it helped them cover those rising expenses. And of course, their net loss for the period is subtracted from equity, showing how the company's losses reduced the overall shareholder value for the period. The cash flow statement tells us where the money is actually coming from and going. For the 9 months ending the 30th of September 2025, their net cash used in operating activities was almost $10 million. This is mainly due to the net loss offset by some non-cash items like stock-based compensation. Investing activities show they spent about $41,000 on property and equipment. This is a pretty small amount, indicating they are not making massive physical investments right now. And then we see the financing activities. The proceeds from issuing shares were over $20.8 million, clearly demonstrating the impact of that February 2025 public offering. This is what allowed them to increase their cash balance significantly despite the operating losses. Now, digging into the notes might give us some more context. Note 1 explains the company's structure and business. They've expanded their operations, creating new subsidiaries in Italy and Israel to serve different markets. This shows a strategic move to diversify and target specific regions. And this part is crucial. They admit they have accumulated a significant deficit of nearly $59 million. They are mainly funded by shareholders and expect to keep spending a lot until they become profitable. They believe their current cash will last them at least 12 months, but they will likely need more money in the future, which could dilute existing shareholders. This is a classic startup situation where they are prioritizing growth and market capture. In the lease notes, we see details about their office spaces in Israel and vehicle leases. Their total future lease payments are about $917,000, with the longest payments extending out a few years. This is a manageable commitment. This equity section is really important because it details their fundraising activities and outstanding warrants. This section confirms the public offering in February 2025, where they issued over 3.3 million shares at $6.50 each, selling even more through an over-allotment option. This is a clear indicator of how they are funding their operations and growth initiatives. They also have outstanding warrants, which are essentially options to buy stock at a certain price. These can become valuable if the company's stock price rises, and they represent potential future dilution for existing shareholders if exercised. This revenue note explains a significant event. They had to fully derecognize a fulfillment asset and contract liability related to a Fortune 500 medical company because they haven't received a purchase order and don't expect one. This resulted in a loss of revenue that they had previously accounted for. This highlights the risk of relying on a few large customers. Interestingly, their remaining performance obligations, which represents contracted revenue not yet recognized, is about $14.2 million as of the 30th of September, 2025. This is a substantial amount and provides some visibility into future revenue, though it has slightly decreased from $15 million at the end of 2024. Now let's talk about the management's perspective on their financial condition. They are doubling down on their vision-based technology and AI for predictive maintenance, hoping to disrupt industries like Industry 4.0. They also address the impact of the war in Israel. While it has caused some minor disruptions, they also note some increased interest from Israeli clients due to heightened defense activity. It's a complex situation with both challenges and potential opportunities. Looking at the comparison of the 9 months ended the 30th of September 2025 versus 2024, revenues are down a bit by 3%. But the story isn't really about revenue right now, it is about their investments. As we saw, R&D expenses are up 56%. They explicitly state they expect these R&D expenses to increase further as they focus on the Industry 4.0 domain. This aggressive investment in R&D and sales, coupled with the revenue dip, leads to that higher operating loss. The company is clearly in a growth phase, prioritizing market share and technological advancement over short-term profits. Their cash flow statement for the 9 months shows nearly $10 million used in operations. This is a significant outflow directly linked to their increased spending on research, development, and sales initiatives. The good news is that financing activities provided over $21 million primarily from that new stock issuance. This inflow of cash is vital to sustain their operations and fund their ambitious growth plans. So, what is the takeaway here? Odysight.ai Inc. is a company in an expansion phase. They are making significant investments in research and development and sales and marketing, which is causing their operating losses to grow. This is a common strategy for technology companies aiming to capture market share and develop cutting-edge products. The successful public offering provides them with the necessary capital to fuel this growth for now. The key strengths are their innovative technology, its potential applications across various industries, and the significant capital they've raised. However, the major weaknesses are the growing operating losses, the reliance on a few key customers which has led to revenue volatility, and the inherent risks associated with needing future funding rounds that could dilute existing investors. Their future hinges on successfully commercializing their new products and achieving profitability. They are making a calculated gamble by investing heavily now, hoping that future revenue will justify the current spending. It is a high-risk, high-reward scenario common in the tech sector. Alright, that wraps up our deep dive into Odysight.ai Inc's latest quarterly report. What are your thoughts on their growth strategy and these financial results? Do you think their investments will pay off? Let me know your opinions in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more of this kind of analysis. And don't forget to join our Discord community for more discussions. Thanks for watching, see you next time.